Okay, our next category is financing. And I would know the definitions of all three of these, and then a few of these I think you'll absolutely have math around. And we've got a math section that we'll review last on our list here. Points, by definition, that is 1% of the amount being borrowed. Not the purchase price, not the appraised value, not the assessed value, but 1% of the amount being borrowed. And for a math question, I absolutely think discount points should be on your list of math questions to know how to tackle. But again, it's 1%. 1 point equals 1% of the amount being borrowed. So 3 points, 3%. 4 points, 4%, but it's of the amount being borrowed. And the other thing I'll just place in here, because while I know we've talked about it, I'm not sure that I hit it with our review the other day, is when you're looking at these values, a great question is, what number are we using to do all of this financing math off of? Are we using the rebuild amount for insurance? Are we using the assessed value charged to us for our property taxes by the county? Are we using the appraised value, or are we using the purchase price value? Well, we're not using insurance. That's just for insurance. We're not using the assessed value. That's just for the purpose of, again, charging your taxes. So now we've got it narrowed down to the appraised or the purchase price. And you're going to use whichever one is less. So if the purchase price is $200,000 and the appraisal only comes in at $195,000, you've got to use $195,000 to use all of this math. Okay, then the difference between that is going to have to be made up in cash by the borrower, is probably what this scenario is going to be for the exam. But in your career, in real life, it's either going to be made up by the buyer, it's going to be, the price is going to be reduced by the seller to match. They're going to split the difference of that $5,000, for example, between buyer and seller. Or it's a contingency in purchase agreements. That's a reason to not follow through with purchasing the house, would be a fourth option. So pay attention to what number you need to use, because that I could see as a great setup on the exam as well, is which of the following are you going to use to calculate financing? And it's between purchase price and appraised value, whichever is less. Now, in your career, hopefully you're doing a really good job of doing research and understanding the value of the properties, so those aren't ever any different. There's not ever an issue. It's basically a check mark. Yes, the appraised value works. Okay, so it's the amount being borrowed that we want to pay attention to. So points, again, that refers to discount points. LTV is the acronym for loan to value. So that's the amount being borrowed versus the amount being put down. So if you're borrowing $200,000, or if you're the purchase price is $200,000 and you're putting $40,000 down, you would divide $40,000 by $200,000, and you'd get an 80% loan to value, which means you're putting 20% down, borrowing 80, which in this scenario means you're borrowing $160,000. That's loan to value. And points and loan to value in a test question would make a great combo, right? So that you got to know how much you're actually borrowing in order to figure out those discount points. PMI is private mortgage insurance. That's the acronym. And private mortgage insurance happens anytime we put less than 20% down. Interest, that is a term used, that is a charge from the bank for letting you borrow all their money to buy your house. And then PITI is a great acronym, not just for the exam, but for your career. You'll hear this a lot. PITI makes up the total house payment or the total mortgage payment you're going to make to your bank. Okay. And it's going to go to 3 different places. P is for principal. I is for interest. T is for taxes. I is for insurance. So the 3 places this is going to go is principal, paying off your balance, just like paying down a credit card. The I for interest, that's going to go to the bank. That's the money that they're making off of letting you borrow your money. Then the TI, the taxes insurance, are going to go into a 3rd bundle in an escrow or an impound account. Okay. And again, any type of escrow account, whether it's impound, trust account, it's other people's money. So that TI, taxes and insurance payment, that's not the bank's money. That's your money that needs to be set aside into this escrow or impound account so that when the taxes and insurance come due, they've got money in that account to pay it for you. And again, the bank likes to pay those things on behalf of the borrower so that they can be in control. That way, if the house burns down, the borrower can't say, sorry, I'm going to default on the loan because I don't have any money to rebuild the house. No, the bank knows that bill got paid and they know what the insurance binder covers so the house can be rebuilt. That's security for them. It's also security to make sure that your property taxes get paid so that you don't default on those and lose the property to a tax sale, leaving them to be the junior loan lien when, of course, they want to maintain first position and be in control. So principal goes towards your balance, interest goes to the bank, taxes and insurance sit in that escrow account. But PITI is the total figures of a house or mortgage payment. Okay. Your financing instruments are going to be your mortgage and promissory note. Your promissory note is just a simple document that says you promise to repay the debt. The mortgage is going to specify how it's repaid, the interest rate, annual percentage rates, when it's due. If it's not paid on that date, what penalties are you going to pay? If you don't pay your loan, what is the consequence for them to start foreclosure proceedings in the instance of pay, stay? So all of that would be outlined on that. And for your careers, when you go to closings, I recommend for your career, you go to your closings with your buyers, even though they might not really need you there. And if you got $1 million listing, I mean, go on that appointment first. But I try to go to as many buyer closings as possible. But when you go on those, it's a good learning experience for you because you'll see all these documents that they actually sign. Because if you haven't bought a home recently, it's easy to forget the process. That or go buy a new house. That's a good way to learn too. Types of loans. Conventional loans is kind of your most standard. Again, anything less than 20% down, you're going to need to have private mortgage insurance, PMI. FHA and VA are good ones for you to review. Both of them have a government interest in it for the insurance. They provide the insurance. So any bank really can do an FHA, VA, or conventional loan. The bank is going to be the one that does the loan. It's going to be the government that provides the FHA insurance. And they provide insurance because FHA loans are as little as 3.5% down. VA loans for our veterans, which is administered by the Department of Veteran Affairs, they can do 100% financing. In fact, they can even finance their funding fee, which is basically their version of this protection. Another thing I would know about a VA loan in terms of a term is the words Certificate of Reasonable Value, CRV. This is basically their version of an appraisal. USDA loans are a rural program. USDA loans, again, are for communities less than 10,000. And they also have 100% financing. So for your career, not for the exam, but for your career, if you're going to be listing properties in any of these small little towns, I'm from a town of 600 in Southeast Iowa. If I was listing properties there, I would become a master at USDA loans, because that would be the perk of buying there versus buying in one of the neighborhood communities that are 15,000. So I would want to get with a lender that was really good at USDA loans. But that's a great rural loan program. And they've got a lot of other great farm loan programs with USDA as well. Amortized loans are going to be a loan with a fixed rate and a fixed principal and interest payment. And it's going to be broken down. If you do a 30-year loan, you're going to make 360 payments. And it's going to break down for you every single payment of those 336 every month, how much is going towards principal and how much is going towards interest. It's a fixed payment. Where an adjustable rate mortgage, known as an ARM loan, that rate can adjust. And a term I would know around that is reverse amortization or negative amortization. Negative amortization, I believe, is in the book that we've been using. I've seen reverse amortization before in some other exam prep stuff. That's where if they're not getting their rate of return that they desire, they're going to start adding that interest payment to your principal balance. So it's called reverse or negative amortization because instead of your principal balance going down, it's coming up a little bit. And then another term I would know on there for amortized loans is reverse mortgage. And that is specifically for people 62 years and older, for them to receive a payment every month against a loan instead of making a payment to pay it off. They're basically using their equity, and they could do an equity line of credit, but this is a way to give them kind of a monthly fee to help them kind of manage their money maybe a little bit too. These are the ads you see on TV with Tom Selleck, Alex Trebek, may he rest in peace, and Arthur Fonzarelli, Henry Winkler. And they get a bad rap. Reverse mortgages sometimes get a bad rap. So my joke is always, if a celebrity shaves their mustache for the commercial, be a little weary. No, it's a good product if it's used for the right thing, just like an adjustable rate mortgage or any type of financing. Okay. Owner financing is going to be like a contract or a land contract where we basically, the owner provides the financing, the borrower makes the payment directly to the homeowner. During a land contract like that, the homeowner still owns the property and they add the contract buyer onto it. So if you've ever gone to the assessor's page, this is how it is in Polk County for sure. I know that I haven't looked at some of your counties on the eastern part of the state. You'll see a borrower in regular print and then maybe 2 more borrower names in italics. That's my clue that that was actually a contract sale. The borrower is providing financing. They'll do that for a short amount of time, and then typically that borrower will refinance to a conventional mortgage of some sort and get the owner off of the title. This talks about the lending process, application through closing. And I guess the 2 big things that I want you to know there is when a borrower does their loan application, they've got 3 days on the front side to review the loan estimate form. Then on the closing end, 3 days before closing, they must have a closing disclosure made available to them for them to review those figures. And the loan estimate form, 3 days from the beginning, and the closing disclosure, 3 days from the end, those must match on anything that is a fee related to obtaining a mortgage. So an appraisal, for example, is a fee related to obtaining a mortgage. So if they quote you $400 on a loan estimate, it must be $400 on the closing disclosure. Otherwise, we've got to restart all the disclosures over and over. We don't want to do that. It would always delay closing. And you'd have all your stuff on a moving truck. No one would be happy. So those must match, which means if the appraisal actually charged $425, the lender is probably going to eat that $25. Okay. So that's kind of the financing process through that. But with that, what's really coming in these financing and credit laws and rules is truth in lending, known as TILA, RESPA, which is the Real Estate Settlement Procedures Act. Those 2 are all around the idea of having the true costs disclosed to our buyers and sellers. That's why we've got that closing disclosure that has everyone's figures on it. That way we know where every dollar went and who it was paid to. The other thing that RESPA really focuses on is they want no kickbacks, specifically between a lender and a real estate agent. My lender can't just give me a fee for bringing him borrowers. Now, will you have lender partners that you refer business to? Yes, but it cannot be for a fee. The other thing about RESPA, besides kickbacks, is those impound escrow accounts that we were talking about for taxes and insurance. There cannot be an inflated amount held in those accounts. They can only hold so many months at a time in there. And I think we discovered that Wells Fargo paid maybe $3 billion or something it was, don't quote me on that, in fines a couple of years ago. And it's because they were found to have inflated too many impound accounts, and they got fined for it. We discussed that earlier. I forget what the number was. I don't speak in billions, so that doesn't seem right to me, but 3 million doesn't seem enough. The last part is debt ratios, credit scoring, and credit history. I would know just a little bit about what makes up a credit score. Typically, it's amounts owed. So if you got a $10,000 credit line, the amount that you have charged up on that affects your score, as well as the big one is, do you make payments on time? Now, in this for math, we're going to come to this, but it does deal with financing section, is debt to income ratios to establish financing. And that's where we talk about that front and back end ratio. that the total amount of debt a borrower can have is 36%, but only 28% of that can actually be house payment. So if they have no debt at all, they can't have a house payment of 36%. It can still only be 28. If they carry debt, the maximum they can have is 36%. So if they've got a lot of debt, that might start eating into their 28% allotment. So again, that'll be a math question, but it is something that we learned in this category, so I wanted to touch base with it. Our next section is general principles of agency, and this is a big section. This is one I would absolutely pay attention to. You got at least probably 10 test questions around this. And I would know the big thing in here is going to be fiduciary responsibilities. But let's, of course, start from the beginning. Types of agents and agencies. So this is where I would know the term brokerage. That's just the art of bringing two parties together. A broker, though, is licensed in order to receive compensation for bringing those two parties together. A salesperson is going to be someone who cannot work independently, but they work under the direction of a brokerage or a broker. Okay. Then they talk about transaction agents or non-agents and a few things like that. Non-licensed agents. These are going to be people that maybe are your accountants, somebody that maybe greets people at the front desk and enters data on the MLS, answers the phone, kind of that traditional role. But they don't do anything real estate. Okay. They don't answer any real estate questions. They're just maybe office staff. B is where I think you're going to have the bulk of your test questions, again, around these fiduciary responsibilities. And your principal is going to be your client that you've got a contract with. And fiduciary responsibility says you owe them something special in the transaction, that they're your first line of representation above anyone else. And granted, you can do single agency and dual agency in Iowa, as long as it's disclosed, both parties agree to it. It's legal, but this really goes through the agent duties of care, obedience, loyalty, disclosure, accounting, and confidentiality. We call that, on here it says cold, but I'm going to have you rearrange that to be cold AC, because of course when we sell a house, we want the air conditioning to work in the summer for you. So that's the acronym that I use: care, obedience, loyalty, disclosure, accounting, and confidentiality. Care is going to say things around the idea that you should have more skill and knowledge than the average person, because you're licensed. You've done all this education. You should know more than the average Joe. Obedience says you're going to do what your seller asks you to do, as long as it's within the law. So your seller says, take the sign out of my yard. I know I've had 35 showings. Say, now, you're sure that's what you want? It's helped us get a lot of showings. Nope, we want this sign out. You take the sign out. There's no law that says there's got to be a for sale sign in the front yard. So follow their rules as long as it's within the law. Care, obedience, loyalty says that you'll put your client's interests above your own. So a really good example is you're showing a house to some buyers and you say, whoa, this would be a great property for my own portfolio. I'd love to have this as an investment property. What do? Well, you let your buyers proceed. You should not ever compete against your own buyers for yourself or for your immediate family. That would put your buyer at a disadvantage because you obviously know the offer that they wrote. Now, you can write an offer on the same property for multiple buyers, but again, not when you got personal interest. Accounting. No, disclosure, sorry. Care, obedience, loyalty, disclosure. This says that you must disclose pertinent facts to the property that could affect the transaction. Maybe it would make a buyer decide to not even go into contract if they knew about this, or it would change how they wrote the offer. So one example would be if you're representing yourself or immediate family. You'd want to disclose that. By the way, that's a state law in Iowa, a great test question for the state exam to be maybe addressed there. Where I think this is really going to go on the national perspective for you is you meet with a seller who says, Amy, I've had water in my basement and I don't want to disclose it because I know it will deter a buyer from writing an offer. Don't tell anyone. We can't do that. So while your instinct might be to not take that listing because we don't want to really work with liars in our business, the truest response to that is it doesn't matter because you must disclose that fact now anyway. Even if they don't, you are now responsible for disclosing it. Because if a buyer didn't know about water in the basement, and there was in fact water in the basement when it rained 8 inches or more, you would want to know that before you purchased. One, it affects the structural integrity. Two, it would affect how you maybe use the property in the future. That corner where water comes in is not where you're going to store heirloom photos from the 1800s of your family, right? Because they would be ruined. Or if you did go under contract, you would maybe write it differently. You would write it subject to a structural report or having a basement expert come and look at it. Okay. So it's a material, I think it's called a latent defect. In Iowa, we sometimes refer that to a material fact or a material adverse fact. Those are very similar terms. Accounting. Now we're to accounting. There are several points in the book for such a small chapter. And while many of them are state questions, I'm going to review for them with you now. One, anything a client signs, they must receive a copy of. Okay. A buyer signs a buyer agency, they get a copy of it. A seller signs seller agency, they get a copy of it. A seller signs the listing agreement, only they need a copy of that. A buyer and a seller sign the purchase agreement, so they both need a copy of that. Okay, so you sign it, you need a copy of it. The next one is when you receive an offer with earnest money, most states have a deadline when that check must be deposited. And in Iowa, it's 5 banking days. Another thing with accounting, it says, is those earnest money funds must go into a trust account, not into the general funds of a broker. That earnest money belongs to someone else. It's not income for the brokerage. And that earnest money needs to do whatever it says in the contract, not pay the broker's bills. So it goes into a trust account. Okay. And the big term around that for the national is you cannot commingle earnest money or trust funds with general funds. The term commingling is illegal. And another word that goes around that is the word conversion. Commingling and conversion, put those together. Okay. Another item in that section is a real estate agent is going to be required by law to keep a copy of their files for a certain amount of time. And in Iowa, it's 5 years. So that's a great state question for you, but that is part of the accounting. The last item around accounting that I want to point out is when a client asks for an update on where's my file at? Where's this at? Where's this at? You must give them an update in Iowa upon request. There's no 10-day, 15-day, 30-day interval. It's upon request. And then confidentiality should be super simple for you. We don't want to share anything with another party that would put your client at a disadvantage when negotiating. So the fact that a seller is willing to take less than their listed price, a buyer is willing to pay more than what they wrote on the offer, anything that is around their strategy, motivation, or finances. Those are my three big categories to remember. Now, under the creation of agency and disclosure of a conflict of interest, that's going to be around single versus dual agency. But another key thing to remember in there is express versus implied agency. You want a clear establishment of your working relationship. And I gave you the example of Taylor Swift. Taylor Swift called a real estate agent who'd been showing her and said she wanted to buy a property. He happened to find one for her that was off the market but was for sale, that was a unit right next to her townhome where she lived. She had talked to him a little bit about pricing, kind of casual, and then just ghosted him. And he assumed she no longer had interest in buying the property, and then later found out she had bought it directly from the seller and had kept him out of the transaction. He sued to get commission dollars and lost, because while he was going through the emotions of acting like a real estate agent, he was implying he was working with her, but they had never had an express agreement of what their working relationship would be for that property or for her journey. There was nothing in writing and nothing even verbally communicated. He was just playing real estate agent without actually having a conversation of their working experience together. So Taylor Swift won that lawsuit and was found not needing to pay any commission dollars. Okay. This talks about agency and agency agreements and key elements of different types of listing contracts and buyer brokerage and tenant representation. The key thing I would know around this is termination of these agreements. And there's several reasons why an agency agreement, either with a buyer or a seller, can go bye-bye. Death of either party, and either party means the client or the broker, by mutual agreement, by bankruptcy, foreclosure, eminent domain, by destruction of property. But the key one that you need to look for is completion of the sale. So a great test opportunity would be, what's your first opportunity to end your relationship, your agency relationship with a buyer or a seller? And the best answer is going to be, you did your job. If you've agreed to be their agent for 6 months and you sell their property, or you sell them a property in month 3, there's no work for you to do that other 3 months. You don't owe them any duties. So your first opportunity to end that relationship would be completion. You did your job. You did what they asked you to do, and hopefully got a big fat commission check.